Hi, I'm Pattu from freefincal. So let's take a look at Navi Nifty 50 Index Fund. This is the new kid on the block with supposedly the lowest expense ratio among index funds with 0.06% and so on. Well, 0.06 is its initial expense ratio. They themselves have made the disclaimer that it can change in future and so on. Now, regular viewers will know what I'm going to say, but if you are interested in passive funds, it's important for you to understand why you should not take any fund seriously just because its expense ratio is low. That's not important. There's much more to tracking an index than just expense ratio, and that's the whole message of this video, hopefully. Alright, so we have seen what AMCs do. They will keep the AMC, the TER row, the total expense ratio low, invite the AUM and then jack it up, right? We have seen UTI increase, the UTI mutual fund, Nifty fund increase AUM. Tata had the lowest TER of 0.05% from July 2019 to March 2021. Then it increased it to 0.15%, from 0.05 to 0.15. That's a huge change. And then to 0.19. They will say relatively it's still lower. That's the kind of argument that they will make. But every fund house will do it, so there's no big deal about it. There's no point in blindly rushing into a new fund house and saying, oh, it's got lowest expense ratio, I'm going to buy it and so on, and then later on it's going to increase it's likely to increase its TER, and then it can be a problem. So and more importantly, there's a lot more to index fund tracking than just expenses, and that's very important to appreciate it. Now in their website, they've made a very clever wording. They don't say lower expense ratio will lead to more returns. They say lower expense ratio will lead to more savings. How will an investor perceive more savings? Obviously, they must perceive it via more returns only. But it's very clever wordplay there. And they claim that if somebody invests 5 lakhs in a fund with 0.06 expense ratio and 0.9% expense ratio, they will save 5 lakhs after 30 years. So on an investment of they will say 30 lakhs after 30 years. That's what I mean. So if you let me say that again. I got confused. So you invest 5 lakhs in a fund with expense ratio of 0.06% and a expense ratio of 0.9%. They say that you will save 30 lakhs after 30 years or 1 lakh after 10 years and so on. That kind of illustration is very nice to see, but it's obviously unlikely. No fund house is going to keep their TERs steady for 10 years. If they keep it steady for 1 year, it's a record. So that's the situation in which we are living in. So let's now talk about why there's more to passive investing than just fees. Now, many people make the mistakes of saying, oh, ETFs have lower cost than index funds. They are better. No, they are not. We have talked about that many times, because you're buying in the market, there's demand supply fluctuations. So ETF returns can be lower and are lower than index funds if you actually use the price to calculate the returns. So we need to look beyond fees. Now, I have looked at a 14-month period between 1st February 2020 and 31st March 2021. UTI Nifty fund had a constant TER of 0.1% during this period, and Tata Index fund had a constant TER of 0.05% during this period. That's why I chose this period. So during this period, the Nifty 50 total return index gave a return of 24.395%, but the absolute return of Tata Nifty fund index fund is 23.547. However, the UTI Nifty fund was able to beat the Tata index fund. Now, how is a fund having double the expense ratio able to beat a fund with half the expense ratio? The 0.1% fund is able to beat the 0.05% fund. How is that? The answer is AUM. The AUM of the Tata index fund is extremely low compared to the UTI Nifty index fund. Now, we must understand that tracking a portfolio is a lot more difficult than saying you have to keep track of dividends, you have to keep track of splits and so on. These are open-ended mutual funds. So people will continuously invest and people will continuously redeem. So suppose a fund manager has got 20 crores or 25 crores AUM. That was the kind of AUM that Tata had some months back. and somebody suddenly puts in 1 crore because they have decreased the expense ratio as an invitation, adding this 1 crore into that existing portfolio, or somebody removes 1 crore for that matter, it's going to be a very difficult task for the fund manager to keep track of the index. Make the portfolio stay close to the ratios of the Nifty portfolio. So that is the problem. You must have a robust AUM. UTI had a much robust AUM than Tata even before this 14-month period I talked about. Now they have a much better AUM. So we must understand that it's not just expense ratio, the AUM matters. So you must have a robust AUM. Now, even bizarrely, IDBI Nifty Index Fund had an expense ratio of 0.3% for practically all of those 14 months. They were able to beat the 0.05% index fund. They were able to beat the Tata fund. They actually got close to UTI. Their performance, 0.3% expense ratio funds performance is close to 0.1% expense ratios fund. The reason for that is the inflow was very less for IDBI. They had pretty much constant AUM during this period, so they could track it efficiently. Whereas UTI, the inflow also started increasing because people have started investing more and more into the UTI fund. There also the fund manager is having difficulty, but they have done well so far. So if you look at all the funds which have done well, ICICI, UTI, IDBI, HDFC, all of them have got very reasonable AUM and to begin with, and then their AUM grow and they were able to track it better. So don't go just by low fees. Fees matter, but AUM matters in an open-ended fund. If your index fund has got 1,000 crores or more of AUM, even if it is more expensive than this Navi fund, it is always better to invest in the established index fund. Whether you are an existing investor in these index funds or a new investor in these index funds, let Navi come. Let us see what kind of so-called disruption they are going to create. Let's see. But I am an investor. I am not an experimenter. I am not here to play around with my money and see, okay, let me put 5% to Navi and see what happens. I have better things to do than that. So let's not play with our money and stick to established index funds.